What is an escrow account? Why did my payment change if I got a fixed rate mortgage? The seller's not ready to leave. Why isn't that? How do we navigate that situation? We're gonna answer all those questions and more. Make sure you stick around to the end for a bonus question that's gonna help you navigate the home process. But real quick, my name is Daniel and I am so excited to have you here at this channel. Welcome to Faith and Finance, where we talk about purchasing houses, but also navigating life correctly. I just wanna say welcome. If you haven't done so yet, smash the subscribe button, go ahead and hit the bell icon to be notified when we release new videos, as we will do this each week. Let's dive into your questions. So I'm really enjoying this mini series where we're going to answer questions that you specifically have. And today I just want to jump right in and answer some questions that I've had messaged over to me since our last video that was released last week. If you ever have any questions that you want, make sure you shoot those questions over and we can answer those on some of these series as well. All right, let's jump into it. First one, what is an escrow account? Oh, that's a great question. Escrow is a fancy term for almost like a bank account for your mortgage. It's like a savings account for your mortgage. What happens with an escrow account when you're purchasing a property is the lender will hold money back to pay your property taxes and to pay your homeowner's insurance. Now, every single month when you make your mortgage payment, part of that payment goes to your principal and interest, and part of that payment goes to your taxes and insurance. This is where it's divided up and into your escrow account. Your taxes and insurance will go into that escrow account, and when your homeowner's insurance is due every year, the servicer will pay on your behalf. When your taxes are due, whether that be once a quarter, twice a year, once a year, depending on your county or city, the lender will take the money that's been saved and they will pay on your behalf. Now, you might notice that you're gonna get a bill still from the city saying your property taxes are due. If you have an escrow account, you can go ahead and write paid by escrow on that document and file it for later. Now, there's a part two to that question. Why did my payment change if I have a fixed rate? I have been asked this question a lot. Why is my payment changing if I have a fixed rate on my mortgage? Well, I'll tell you exactly why. It's because of the escrows. What happens every year when your homeowner's insurance goes to renew is that based off of the value of homes, based off of the area, based off the policies and whoever the insurance carrier is, they can increase a premium or decrease a premium. So if they're increasing a premium, that means your escrow balance is going to be short. And what the lender will do, or the servicer will do, will make sure that they add payment or add extra cost to your mortgage payment to cover the difference. The same thing can happen with your property taxes. See, what's happening right now is the value of homes are going up. Well, if the value of homes are going up, then that means the assessed value of your home is going up. Basically, whatever the city is calculating to pay your property tax. If the assessed value is going up, that means your homeowner's insurance is going up because the coverage has to be there to cover the new value. The cost to increase between construction supplies and different things in the economy is driving up property taxes, and it's driving up homeowner's insurance. So don't be nervous if you see your mortgage payment change. Understand that it's either because of your homeowner's insurance or probably your property taxes. Feel free to shop your homeowner's insurance when it is up for renewal. That's always a good tip. And also, if you have a question about your assessed value, you can always dispute your assessment with the city. Check with your locality and county to see what that process looks like. Oh, here's a great question. I was given a home and it's paid off. Is that gonna affect me if I wanna buy something else? Well, congratulations, number one, you were just given some equity. What happens when you are given a home? Let's say that it was left in an inheritance or a trust, and now the house is being passed down to you, but it's in a different area that you don't necessarily live in or want to live in. Does that house affect your qualification moving on to the next one? It can. And let me tell you why. So when a house is given to you and it's fully paid off, meaning that there's no mortgage on there, the lender will still count the property taxes against you. And also, if it's in a homeowners association, they will count that against you as well. You're not necessarily required to have homeowners insurance on a house that is paid off. That's completely up to you. I would always check with a professional to see if you should. You always want to make sure you're covered. But if you don't have homeowners insurance, that's not going to be counted against you. So when you're qualifying for your next property, we always want to make sure, debt to income wise, that with the property taxes, if there is homeowners insurance, the HOA or homeowners association fees, that you qualify for your next mortgage. Now, let's say, for example, you have a property that's paid free and clear, and you want to sell it at the same time you want to buy. Is that possible? 100%. And you can actually use the funds that you get from selling that property as a down payment to your next one. But just make sure that if you did inherit a house and you did get a new property, you're listed on the deed, that you check with your lender or your loan officer that you qualify with that property tax payment. Oh, here's a really good question. The seller is agreed on my offer, but they don't want to move out until 2 weeks after closing. How do you navigate that? So this is a very common situation that happens. Sellers, what they'll do is they'll sell a property or they'll take an offer, but they say, hey, we need to build in a little bit of time, a little bit of a gap between closing and us moving out. Well, you might ask yourself, well, am I liable for the property with them living there? Yes, you are. So here's what happens. There is a document called a rent back. And what can happen is if you need a very small amount of time, you always want to check with your loan officer for the amount of time, but let's say it's a couple weeks, you can do a rent back where you become a temporary landlord for 2 weeks, and it can be an agreed upon rent that you pay. Whether you want to pay the mortgage payment or a little bit more, it's completely up to you. There probably will be some sort of a security deposit that will be collected at closing, but this allows you to act as a landlord and cover the 2 weeks while they're moving out. So it's a very simple process. You just want to check and make sure that it does work with your lender that you're working with. And again, if you ever need to get pre-qualified, reach out to my team. You contact me. We'll be able to help you and connect you with anybody that you need in a transaction. All right, let's check this question out. Here's a question. I need to buy a car. I've heard that if I purchase a car that it could ruin my chances to buy a house. The reason being is because a car payment can be extremely expensive depending on what type of model or maker you're getting. So what you want to do if you have to purchase a car, you always want to make sure you check with your loan officer first to see if you qualify with the debt to income. If you don't qualify with the debt to income, you might want to pause that car purchase. If you do qualify, it might be okay to proceed with the car purchase, but you have to make sure that you check before ever making a big purchase when qualifying for a home. Oh, here's a good one. Someone's asking, I heard that you can purchase a property without showing income. Now we're getting into a little bit different type of buying, a little bit different type of qualification. And what this person is referring to is an investment property specifically called a DSCR loan. A DSCR loan is a debt service cover ratio loan, which allows you to qualify based off of the income of the rental and the expenses of what it might cost you. Now, this is a little bit more advanced, I would say, than your first home, but this is a way that you can purchase a property without showing income and use the income of the rental to qualify. If you're completely lost with everything that I'm saying, I will be making an extra video about the DSCR program. But if you have questions about that, reach out, because the DSCR loan allows you to purchase an investment property without showing income. So if you're a self-employed business owner, maybe you're 1099, maybe you have a property and you're in between jobs, or you're living off of a fixed income Social Security, a DSCR program might be the fit for you if you do not have the income to qualify. And I appreciate you sticking around to the end. It's always my team's greatest goal to help out homeowners, making sure that we have a transparent process, making sure that we're educating and truly providing value to the home buyer. If you stuck around from the end, I have something special for you. It is our free home buyer's guide. Now, this guide is the paper form of so many different years of supporting home buyers to help them qualify. But this home buyer's guide is for you. You can specifically grab it from the description. Click the link and you can have a free home buyer's guide that has perks and different tips and tricks for navigating this home buyer's journey. And also it's going to include my link to contact me if you are interested in getting pre-qualified or have questions about the home buying process. My team handles all over the nation. So make sure you reach out. Stay tuned for part 3. We can't wait to see you next time.